Only 16% of Californians can afford to buy a home. Today, we're diving deep into the shocking state of the California housing market. Home sales just fell for the fourth consecutive month, while at the same time, we saw the existing home price rise. Existing home sales totaled 240,940 sales on an annualized basis in September. That's down nearly 5.4% since August and down nearly 22% year over year. So when people talk about the idea of the California housing market crashing, the reality is it's already crashed, but not in the way that most people want to see. Most people are expecting a crash in home prices, but because we're currently sitting on record low levels of inventory, we're not seeing the crash that many were expected. Rather, we're seeing a crash in the number of transactions actually taking place, and that's because there's just less able demand out there in the market that's able to buy homes with interest rates sitting at 8%. The median home price in California just rose for the third consecutive month, recording its largest year-over-year gain in over a year, with the statewide median home price sitting just over $843,000, which is down nearly 2% from August, but up 3.2% from September of 2022. So at the moment, you kind of have the tale of two different markets. You have home sales plummeting, but at the same time, you have home prices rising. And one of the main reasons you're seeing such a difference is based on the way they calculate these numbers. And with that said, you're likely going to continue to see year-over-year increases when it comes to home prices, because this was the time last year when we saw interest rates peaking and there were just less transactions out there taking place, less demand out there in the market. And so year over year, those numbers are likely to improve. But as we start the new year, assuming interest rates continue to stay at levels that we're currently seeing, you're likely going to see those year over year home price numbers start to turn negative, which is actually contradictory to what the California Association of Realtors is predicting, as they're expecting a rebound in 2024 with home prices expected to increase nearly 6.2%. And at the same time, they're also expecting a rebound in the number of transactions actually closing, up nearly 23% to a total of 327,000 transactions. And the main reason they're predicting this rebound is because they're expecting mortgage rates to drop, they're expecting the economy to stay strong, and they're also expecting a limited amount of housing supply, which will essentially continue to put upward pressure on house prices. So what does that mean for you as a buyer or seller in the current housing market? Well, that's what we're going to dive into in today's video in a little bit more detail, right after you hit that thumbs up if you find any value in my videos at all. And also do me a favor and subscribe to the channel to stay updated on everything California housing, inflation, interest rates, and real estate related by hitting that subscribe button. Have you ever heard the quote, when is the best time to plant a tree? Where the answer is 20 years ago, and they say, when is the second best time to plant a tree? And the answer is right now. So I'm going to ask you a similar question, but a little bit different. When was the best time to buy a house? 20 years ago. When is the second best time to buy a house? And the answer is right now. Well, it all depends on where you are in your life and what you're trying to accomplish. In fact, I never want my channel to be about pushing people to buy prices. I really just want to provide information, provide data, and let you make the decision for yourself. But with that said, did you know that the median home price in October of 2013 was sitting at $384,000? And as of today, we're sitting at $843,340. So within that 10-year period, we've seen home prices appreciate 120%. That's 10.4% on average per year. Now, there is something to keep in mind there. That does vary by regions. Areas like San Francisco have seen home prices increase nearly 200% during that period of time, whereas homes in the Central Valley have actually increased less than 100%. And that all goes back to what we say all the time. Real estate is local. So some areas might end up doing better than others. But here's what I want to say about that. There's a lot of people that look at appreciation like that and think that that's going to continue year over year. And the reality is we've seen home prices increase more in the last couple of years due to artificially low interest rates. And now that interest rates have moved back upward and there's just less transactions out there taking place, the reality is you're not likely to see the same increases going forward. So if you're buying a house simply because you think the home is going to increase in value, and within a couple of years you're going to be able to sell it and buy a larger house and keep doing that until you get your dream home, I would tell you to stop and reconsider your decision. You shouldn't be buying a home at the moment unless you have a longer term time horizon. And that's because there's a really good chance that we don't see the appreciation that we've seen over the last 10 years over the next 10 years. There's a really good chance that we see home prices move up a little bit and move down a little bit, largely based on what happens to mortgage rates and what happens to inventory. If we see mortgage rates continue to stay high and even move higher, chances are you're going to see home prices come down. But with that said, they're not likely to come down in any meaningful way unless you see supply continue to grow. And because many homeowners out there in California have locked in substantially lower interest rates than we currently have today, those homeowners are just sitting, waiting to see what happens to the market before actually putting their home on the market and making that transition. So they're really sitting in a good place, which means that inventory isn't likely to come to the market. But once they decide that they're a seller and they're going to put their home on the market, a lot like me at the moment, I'm buying another house at the moment and I'm putting my home on the market in order to do that. But I'm putting one on the market, taking one off, which means no net inventory is actually created. In fact, the house I'm buying isn't even on the market. So we're actually pulling one home that is on the market off and not replacing it with anything. And I personally feel like that's the market that we're going to be in for the next couple of years. You need a substantial improvement in one of three things in order to see the housing market improve. And all three things I'm talking about circle around housing affordability. Because housing affordability is sitting at 16% here in California. In fact, it's probably less than that because interest rates are currently at 8%. You just have less able demand out there in the market. You have people that are willing, want to buy homes, but you just have less people able to do it because of housing affordability. So what three things have to change to improve housing affordability? One is house prices, which at the moment we're talking about 3 consecutive months of increases. Now, that is likely to moderate here over the next couple of months, but not really in a way that would improve affordability. The second thing that we can talk about is wages. And while wages are continuing to increase year over year, they're not increasing in a way that's really assisting with affordability. But the last leg of the stool here is the one that can really impact affordability in a meaningful way, and that's mortgage rates. At the moment, with mortgage rates sitting near 8%, it's nearly 54% more expensive to buy a home this year than it was just a year ago. So if you're somebody out there wanting housing affordability to improve, you need mortgage rates to come back in a meaningful way. By every 1% that mortgage rates go up, nearly 5 million people are actually blocked out of the housing market. They're no longer able to afford to purchase a home. Actually, what we would like to see is we would like to see home prices come back a little bit, wages continue to go up year over year, and interest rates come down, because that would be the best of both worlds, giving more home buyers an opportunity to purchase a home. But here's the problem. At the moment, the Fed is stuck on looking at the employment numbers. They want to see employment come down. They want to see employment get worse by going up. They want to see more people unemployed before they start to reduce the Fed funds rate. Now, the Fed funds rate doesn't directly correlate to mortgage rates, but we're not likely to see any real improvement in mortgage rates until the Fed takes their foot off the gas pedal. So when does that actually happen? Well, at the moment, the economy looks really, really resilient, with many of the reports out there coming in stronger than expected, even though inflation has started to moderate. And because of this, the Fed's speak, if you will, is that interest rates are likely to stay higher for longer, which leads me to believe that we're not going to see any real improvement in housing affordability, at least for the next couple of months. So with that said, it's very difficult to pick tops or bottoms in markets. So if you're a buyer out there, stop looking at the headlines, stop paying attention to what the news media is saying, stop looking at YouTubers who are talking about the market crashing or the market going up another 10% or whatever, and just focus on whether it's the right time in your life to buy a house. Can you afford it? Do you have money in the bank? do you have that longer term time horizon? Because if I had to guess, you're not really going to see any real improvement in the housing market anytime soon. I think mortgage rates are likely to stay higher for longer. I do think they are going to continue to moderate, especially as the economy shows signs of weakening. Now, that's not going to happen next week or maybe next month, but it is likely to happen over the next 6 months. So as that happens, the Fed is likely to take their foot off the gas pedal and at least ease somewhat when it comes to their verbiage. And at some point, they're going to have to stimulate the economy because there's a really good chance that we're going to be heading into a recession as the economy grinds to a halt. But here's the thing, that's not happening right now. And even if that does happen, that doesn't really mean you're going to see some huge increase in inventory because nearly 90% of homeowners have an interest rate below 5%. There's very little incentive for people to go out there and list their homes on the market unless they have to make a transition, unless they have to do something. Now, some people are going to lose their jobs and they're going to have to sell. But a lot of these people have equity in their property, so they're going to be able to sell it at market value. And because there's a lack of inventory out there on the market, it's not really likely to impact the market in any meaningful way, unless all of them did it at the exact same time in the exact same market, which isn't realistic. And because supply is staying low and demand is low, you just kind of have this lull in the market, which is exactly what we're seeing now with just less transactions out there. Now, if we do see mortgage rates come back in a meaningful way, somewhere in the low 6%, somewhere in the mid 5% range, which is actually what I was predicting towards the end of this year, but I don't think that's going to take place. But as we see that happen, you're going to see buyer demand pick up because it's going to improve affordability. More people are able to buy homes at that time, and that's going to unlock some of those people that aren't willing to sell because rates are too high. So as rates come down, those sellers are going to put their homes on the market, which means there are homes for those buyers to buy. But here's the caveat. Those sellers are also buyers. So not only are they putting one on the market, they're taking one off. And in order to see home prices come down in any meaningful way, you need distressed sales. You need homes coming to the market where the seller is no longer a buyer. And in my experience of 20 years of selling real estate, people don't sell their homes to go and rent. They don't sell their homes to become homeless. In fact, it's quite the opposite. People sell a home and buy another home because once you're a homeowner, you don't really want to become a renter again, at least in most cases. And another stat I actually found interesting is that the number of people reducing their home prices this year, even with interest rates higher than they were last year, because interest rates peaked last year just over 7%. This year we're sitting at 8%. But this year we only have nearly 33% of people reducing their list price, whereas last year we were sitting near 43%. So there's less people out there reducing their prices this year, even at a time with higher mortgage rates, which tells me these sellers aren't desperate to get their home sold. Maybe they're just in a position where they're putting it on the market to see what they can get, or maybe they're not serious sellers to start with. And the last thing I'll point out is inventory at the moment is still sitting at levels well below where we were this time last year, even with mortgage rates higher. So in order to see big decreases in price, what you need is new listings coming to the market to spike. And what we're seeing at the moment is inventory isn't spiking at all. It's a gradual increase, and that's primarily because homes are sitting on the market longer due to affordability and due to seasonality, which we've talked about in the past. So if you're currently a buyer or seller out there in the market, focus on the data. Don't focus on the headlines because the data never lies.